Good morning. Well, afternoon now. It is afternoon.
Oh, you are ready. That's nice.
These. Okay, you want one of these, John?
Definitely, because it's a new version.
Oh, it's just a couple of extra
Okay.
slides, a few different things. Yeah, I never do two things the same, so you get used to that. Nothing is always the same. The world keeps moving, and we'll find that out today. But first of all, I'd like to just get to know your names. What's your name?
Wayne.
Wayne?
Yeah.
Very good to meet you, Wayne.
My name Hung.
Hung?
Hung, yeah.
Hung.
H-A-N-G.
Hung.
Yeah.
Very good, Hung. And your name?
I'm Neringa.
Naringa. Yeah, very good to see you too. Okay, now what we're going to do today is talk about regulation in accounting. And I want to put that into a big picture because it's very complex and it's something that we all have to deal with. Whether it's regulation about how we drive a car, how we get on an aeroplane, you know, the changes from not like the 9/11, the hijack era, we all have to change the way things get done. And it's very similar in accounting. As problems occur, we have new rules, new regulations. So this is something that we need to look at in how we understand accounting. So don't think of it as something in the book. It's something that happens every day. Now, I know we ask you to do things like read the newspaper. Do you get asked to do that by other teachers in your courses?
No, you just do it each day. It doesn't
You
matter
do
whether they
it?
ask.
Good. Okay, so you keep up to date.
Yeah.
So I just happened to read the newspaper on the weekend, the Financial Review. So it's a good newspaper for anyone who wants to be an accountant. Okay, you want to be an accountant? Yeah. You're studying accounting, you probably do. So this is all about finance and financial news. And any time you pick up a newspaper, there are stories in there. And you should be thinking, how does this affect me? How does it affect accounting regulation, accounting practice? Now, even on this front page, there's a few things. First of all, there was a big story on the weekend about Lehman Brothers. You remember a US bank, one of the big 4 US investment banks. They went broke in the global financial crisis. And in Australia, we had a decision made by our courts, Supreme Court, that Lehman Brothers was going to be found guilty and have to pay compensation because the information they had used to sell securities to various purchasers, in this case government agencies and buyers, was misleading. So this is a really good story about accounting information. And what you need to understand is when we talk about accounting regulation, there are many parts to it. So we're going to have a look through all of the parts of accounting regulation. So understand that the law is really important. So this is a legal thing about Lehman Brothers. There's every likelihood there'll be an appeal to the High Court. But this is important because this is a test case, a global test case. The first time anywhere in the world that a court has made a ruling on the Lehman Brothers collateralized debt obligations, CDOs. These were financial instruments that were issued by Lehman Brothers to investors, signed off by auditors and accountants and investment bankers and credit rating agencies saying that these were good securities. They ended up being worthless. People lost lots of money, and now there's an opportunity perhaps to, we'll see how this plays out, because I don't think it will just end here. It will no doubt go to the High Court. I'm sure there'll always be an appeal. These are very complex matters. There'll be lots of lawyers, because the money is very big. They're talking about millions, billions of dollars. So it's big stakes. People will spend all day in court talking about it. Now on the very bottom of this page, in small red writing, you can read, I'll show you, it says, I'll read it out, it says, CBA pearls are equity dressed up as debt. See that? Okay? Again, these are financial instruments. Financial instruments. These were issued by the CBA's Commonwealth Bank of Australia, one of our big banks, big 4 banks in Australia. And part of their investments, They sell securities to investors. And one of the big questions we have as accountants is what are the financial relationships in a balance sheet. So why is it important if something's debt or equity? Why would that matter? What do you do? You did do financial statement analysis a long time ago. What's the accounting equation look like? Who can do this? First year accounting. What's the accounting equation? I'll have to remind you. Okay, your assets equals your liabilities plus equities. What's the relationship between, we call liabilities is our debts, so debt, equity. So we've got a debt-equity ratio, pretty common ratio. What does that tell us? What's a debt-equity ratio normally tell us? Pardon? Sorry? If you've got lots of debt and not much equity, what would you say about this company?
They're in debt.
In debt? But what does that mean? How do you interpret
They
that?
don't generate enough of equity for the stockholders.
No. It's not about generating. It's high risk. The number one word in the world, okay? We all worry about risk, don't we? So we normally go debt, equity, and if debt's very high, so we have most of our assets are financed by debt, by borrowings, we say that's equal to risk. Okay, that's our key measure. What makes an investment risky is if you borrow lots. Now we know in the case of Lehman Brothers, and they do lots of fancy accounting. If you want to know why these companies play around, and exactly the same Commonwealth Bank, exactly what Lehman Brothers did, they play around with these things. If we can pretend we can shift stuff up and down here, we got the same assets, or we may even fiddle around with our assets, and I'll talk about that in a minute with Lehman Brothers. But what the companies do is try and play this game here, moving things between debt and equity. That means if they can move more stuff from liabilities, actually treated as equity, that is going to reduce their risk. They have more liabilities, more debt, it becomes more risky. Why? If we look at the asset value, say we have 100 here, 100 million, 100 billion, whatever number you want to put, and we have 50 plus 50, that's pretty normally considered very conservative. Okay, very conservative. But what happened in the global financial crisis is that a company like Lehman Brothers had this kind of number, 95 to 5, or even higher, maybe something like about 97 to 3. So everything is tied up in debt. All their assets are financed by debt. What happens if the asset falls in value? Only has to fall 3%. Very little. They're wiped out. Okay, that's what happened. So even say their assets come down, we have a financial economic crisis. Assets, they go to 80, 20% right down in assets. We got 97, and so we got minus 17 here. Plus minus 17. Okay, so the shareholders all wiped out. Company goes bankrupt. Okay. So what else could happen? What happened in Lehman Brothers? Well, it didn't happen in Lehman Brothers because they didn't get bailed out. But what's happening in Spain, Portugal, Greece? All of these countries now have banks that look like this. They have negative equity. What happens? How do they get saved?
From the European Union, they just give money banks. But
Okay.
it's not helping, no.
Okay, well, it doesn't, maybe that's another issue, but what this means and what happened in Merrill Lynch, Citibank in America, this negative stuff, the government comes in. Who's the government? The taxpayer. Okay? So you and me generally, we are paying all our hard-earned money to save these bankers. Okay? They've all spent all their money, got themselves into debt. Okay, so the government gets involved. We've got money coming back in to buy up some of these troubled debts. What happened last week, it's probably not on the front page here, but you may have read, you've been reading newspapers, what happened in America last week or so?
They just in so much debt, like everything, the property prices went down, and everything is in bags because they don't actually own anything, like people are not owning, so they cannot pay it out because inflation is higher.
Okay, that's part of it. But specifically an event happened last week in America. Do you know the central bank in America, what it did? The Federal Reserve Board, it's called Federal Reserve Bank of America. You know what they did last week? You heard of quantitative easing? This term, quantitative easing? So the Federal Reserve Board in America, Federal Reserve Bank, is now buying mortgage-backed securities from the banks. They've gone into the QE, what they call QE3, quantitative easing 3. It's the third phase of basically creating new money to help grow America's economy again. Again, we've got mortgage-backed securities, which most banks are secured. The assets of the bank are all the loans they've given out. That's their main asset, and they're secured against property. A lot of those are worthless because the asset values have come down. So the government buys these up to prop up the bank. And they're doing that. $40 billion every month. And Ben Bernanke, who's the chairman of the Federal Reserve Bank, said they're going to keep doing that for as long as it takes. Not going to stop. $40 billion every month. Buying troubled assets. So this is the sort of issue that underpins accounting regulation. Okay? Why do we have regulation? Because financial markets get into trouble. Okay? We can tell the story over and over again. The good thing about it, you are students in really exciting times. You feel that? Really, it's all the stuff every day. There's
happening,
billions
frauds and frauds.
all around you. There's problems, and it's newspaper, headlines, TV, internet. You can find everywhere stories about financial crisis, economic crisis. Okay, which is very interesting. It's good for you as students because you can learn all these things, learn all the games that they play. So I talked to you a little bit about Lehman Brothers a while ago because they happen to be in the news. And they have really interesting practice. They had many interesting practices, but no different to many things that have gone on in the past. So what Lehman Brothers used to do, they've got this accounting equation here, and they had, for example, a balance sheet that looked something like that. So they, it might have been, is into billions or nearly trillions of dollars. So they've got huge amounts, maybe in their asset side. Lots of these things. But every quarter, what they did is they had introduced a thing called a repurchase agreement. Or for short, a repo. So this is a financial instrument that Lehman Brothers created. They were the masters of financial innovation. And so when you read about Commonwealth Bank making up some hybrid financial instrument, whether it's debt or equity, it's all about these kind of games. Accountants are really creative people. You creative? You creative? You think you are? Will you be a good accountant?
After reading such news, you just become creative.
Yeah, you make Pablo Picasso look like he was just a baby. These guys can make anything disappear, magic. So what did Lehman Brothers accountants do? They had these repurchase agreements, and they said every quarter that we want our balance sheet to look better. How would you make your balance sheet look better? What's a quick way to make that balance sheet look better? Less risky. How would you make it less risky?
Increase equity.
Oh, okay, yeah.
Increase profits.
Okay, you could. There's lots of ways you can paint this balance sheet. Okay, your one is to increase equity and increase profit. But that's not the balance sheet. Profit's in the income statement. You're going to make profit anyway. You're a good accountant. You don't have to worry about it. You want to just make the balance sheet look better. So you've got to change these numbers here. What could you do? Sorry?
Reduce debt.
Decrease liability. Okay, that's very good. Okay, so we can decrease liability. You were going to say something too?
The topic already.
Same. You're going to both decrease liability. You going to do anything, Naringa? You want to make the balance sheet look pretty.
Yeah.
Less risky. How? Okay, we want it less risky. So we want a better debt to equity. We want to get this debt to equity ratio down, don't we? Okay? That's the aim of the game. So you're a creative accountant. So we had this thing called repurchase agreement. So what the bank did, it's basically what you guys are saying. You're thinking right. We didn't worry about equity because we're not going to put more money in because we're smart guys, you know. We're going to make more money. Why do you have low equity? Why do you do this? Why do you have this highly levered, highly structured thing in the first place? This is where your profit comes in. Okay? Let's assume we've got 10 of profit.
Reduce expensive and
Okay? We've got 10, say we've got $10 of profit. What's the measure you're going to look at here? What are your two key measures that you're going to look at for profitability? You know, return on investment, ROI? ROE, you know the other one, don't you? Okay. So, what's our return on investment in this one? $10 profit or 10 million or 10 billion? We've got 10 billion profit and 100 billion in assets. We're getting 10%, aren't we? What's our return on equity? 200%? Is that right? You guys are pretty, you're the smart guys, aren't you? Okay. You have a low equity, don't you? Because if you've got 5 billion in equity and you've got all this gearing, then the return comes back to your shareholder. They are the primary return. They don't want to increase equity because they're making great profits. All the banks, keep in mind, all the banks were making great profits as long as the markets kept going up. Okay, so we don't want to change the equity. We'll just leave that there. But what this repurchase agreement was doing, said how can we get a better, what's the problem here? We've got 10% return on investment. We've got $100 billion tied up in the market, only getting 10% on it. How can we make that look better?
invest more.
No.
No, you don't want to invest more.
You want to be creative accountants, okay? So we can say, okay, that's our numbers. What ones can we muck around with? We figured out we can muck around. We can make any profit up we like. We're good accountants, so this number could be anything. But we just say that we'll keep it at that level. This one we don't want to muck around with. So we can only muck around with these two, can't we? what can we do? We can get rid of some of our assets, get rid of some of our liabilities, repurchase agreements. So we get rid of all these. So what Lehman used to do, every quarter, get rid of 50 billion out of there, 50 out of here, sell them off, but repurchase them the next day. Okay? So our balance sheet then looks like 50 equals 45 plus 5. Okay? Less risky balance sheet now. We've now got 20% equity, or 10%, sorry, 10% equity, sorry, in the business. So it's less risky. This is what the repurchase agreement did. They sold these off to the market with a binding agreement to buy them back 3 or 4 days later. So every time the financial year ended, Lehman got rid of them. After that, they're called repurchase agreements. They buy them all back. So they 2 days later, they're all the same. Now, the auditor comes along. At this point. Auditor of the big accounting firm, Pricewaterhouse, Coopers, any of these big accounting firms. They come along and go, this is the balance sheet. Oh, it's all good, very good. Good balance sheet. This goes to the financial markets. Lehman Brothers is a great company, getting good returns and less risky. Okay? Then, unfortunately, when the global financial crisis came, they couldn't do this anymore. Couldn't make these tricks. And of course, all these mortgage-backed securities out here, instead of having 100, they might have only had 50, but they've still got 95 here, wiped out. And the US government said, we're not coming in to help you. They were the only bank let fail. And of course, nobody knew that this 100 billion or trillion of dollars was all over the world. In Iceland, in Ireland, in Australia, in China, in Japan. Every country had bought all these because these were AAA rated, AAA, high security. The auditors ticked them off. Credit rating agencies, Standard & Poor's, Moody's, Fitch, these kind of guys, ticked them off. Great. Okay, that's what happened. Creative accounting. So, what are you going to do? You're now the Prime Minister of the country. What will you do? You've got a new job. You're not an accountant anymore. You're the Prime Minister. You go. Who's upset? Who's going to be talking about this to you? Who's going to be on the phone? Anybody going to ring you up? Send you an email?
Definitely.
You're the Prime Minister. You expect to get lots of phone calls? Maybe you get a bomb threat too, I don't know. They go, hey!
Where's my money?
I worked for 65 years. I'm a pensioner. I've got, all my money was in here, AAA rated. I've got nothing. I'm homeless now. I'm just a voter. Then you might have another person saying, oh, I run this government agency. We've got no money for the next 10 years. We can't help any children. We can't run schools. We can't have parks or gardens. You're the Prime Minister. What are you going to do?
Increase tax.
Oh, you're a good Prime Minister. You'll be kicked out next election. Nobody will vote for you. Can't increase tax. Okay,
Badly you can.
You can try it, but many voters will be upset, won't they? What do? You want to try one? You're the Prime Minister now. What will you do? You're not going to increase tax, are you? You're going to blame somebody else. You should blame.
Yeah, was checking the monitors.
Yeah, let's go and kick some accountants, okay? We want to get these guys kicked.
Who gave those AAAs to
These
them?
go bad accountants. Okay, they're going to go bad guys.
Okay, they use that creative accounting. They just adjust it to how for their own benefit.
Yeah, well, the bankers, you're going to say, oh, these bankers are bad guys. they shouldn't get paid so much. Because keep in mind, these bankers are getting paid all this based on this profit here. We want a big profit. The bankers take home bonuses, lots of money. Even when they got bailed out, they took home lots of money. Lehman Brothers bankers in their derivatives department were allowed 50 billion of bonuses out of the troubled asset repurchase from the US government. Because the bankers said, we can't work if we don't get a bonus. We don't work. There are only people in the world who won't work without a bonus. They couldn't work. So the government said, here's all this money you can take as a bonus to help you through this difficult time. But that's another thing. You need to have a good president, like President Bush was around in there before Obama came in. He said, you can have a bit more money. Your poor bankers, you only got $50 million last year in your paycheck, or $300 million. Who?
If you give the bonus to the bank, the bonus will come from to the public.
What will come? Sorry, just explain a bit more.
If the government has no money, that's the problem.
Well, the government can always have money because the government can print money. Unless you're Spain or Greece.
Yeah,
'Cause
make
everywhere
the
they-
inflation go
Yeah.
skydiving.
You can't just make the money up. Governments always make money
no
up.
way.
They do, all over history.
Let's
Everyone.
not do Somalia.
Everybody makes the money up. So money is not a problem if you're a government. You can do two things. You can tax the people, or you can print more money.
So
Two
gonna
choices.
tax them.
Very easy. Okay? And governments, they've got to balance it a bit each, They'll tax a bit and then they'll cut a few of their costs and things like that, like they're doing in Australia now. Saying, we've got too many workers, we'll
Yeah,
make
they
people.
legislate for
Okay.
them.
So these are the games. But if you're the government, what I was saying, if you're the Prime Minister or the President of your country, and all this is going on, what happens is you want to be in control. I am going to be able to save the country. This is what's gone on. We need to have more regulation. We need to fix this up. There was a problem here. We can get the auditor. We have better regulation. Have more regulation about this. We'll have more regulation about these things. Generally, whenever there's financial crisis, governments respond by creating additional regulation. That's what happens. They may go into the accounting area, into the governance, into the executive remuneration. A lot of regulation now about executive compensation and remuneration. All these things go on, and then everyone says, after many years of inquiries, committees of inquiries, this is what ends up. We get a new Companies Act, new requirements in the regulation. So this is the background to what we're going to talk about today. So you understand the context? Okay, it's very live. And but this thing happens all the time. Economic crises, corporate crises are not new. They're not just happening today. We started companies about 160, 170 years ago. A modern corporation was established. And every 5, 10 years, we have what we call an economic cycle. The economy grows, expands, we get a bubble, then there's collapse, there's more regulation, expanding, collapsing. This pattern goes on, and we can trace that. Now, the one that we are dealing with right today is described as one of the major economic events for the last 70, 80 years. In the 1930s, we had a major economic crisis, often referred to as the Great Depression. It affected many countries around the world. And that was seen as a bigger event than today's crises. And today we have a lot more skills and resources and knowledge about how to manage countries and economies than we did back then. But even so, this is a major event. It's now been since 2007-8 when the crisis started to unfold. We're now into our 5th year of and what happened is initially this crisis was on corporate balance sheets, particularly in the banking sectors, but affected many other companies outside of banking, and it transferred across more recently to governments, because governments assumed a lot of the debt, and so we now have a crisis in government finance around the world, in many countries, particularly in the Eurozone. So major crises of confidence in the financial balances of companies. Now, we had this a few years before. We had a tech bubble. You may remember, you're probably all young. I just remind you, in about year 2000, we had, during the 1990s, a big bubble, and we called the tech bubble, and the tech boom and bust. And that happened around 2000, 2001. Then we got the big market freeing up of liquidity, and a big bubble in securities, and particularly in mortgage-backed securities in real estate, particularly in the US, but it happened pretty well all around the world. But they were the ones that uncoupled first. Before that, we had an Asian currency crisis, 1997, 98. Speculation over government debts, particularly in Thailand, Korea, Malaysia, Indonesia, these kind of countries. Before that, we've had booms and busts. We had mergers and acquisition booms. We've had booms about commodity prices. We had an OPEC oil crisis in the 1970s. So every time economic systems or parts of economic systems get out of balance, we get a crisis, we get a response to crisis. And that response is normally a form of regulation. Okay? So that's the big issue. Accounting regulation is nothing special about it. It's part of a regulatory package. So what we need to do is think about how it all fits together. And that's what we'll look at in the next little bit. Try and put some accounting theory around this. But keep in mind, at any time when you are looking at things, make sure you can take it back. When I tell you to be a Prime Minister or you're going to be an advisor, what you should be doing in this course is developing your analytical skills. Your ability to say this event is occurring, this is how it will have impacts, and you can then give advice to people. You may give them advice to the company board of directors, you may be giving advice to auditors, you may be giving advice to a government minister, anything. Your job, you're finishing this year? You're doing MPA? Yeah. MPA, and you'll all be graduating soon? Not so soon. Oh, hopefully you'll graduate sometime. Then someone will say, oh, you've got a good degree. I want your knowledge. I'll pay you a big salary to give advice, okay? That's what you should be doing. So what I want you to aim for in this course is to develop your skills so you can take all of this stuff that's in your textbooks, in your course notes, in newspapers or wherever, and Craig Deegan, he puts lots of examples from newspapers, be able to say, what does this mean? How can I tell someone about it? Oi, that's no good.
Yeah, it always does.
That was it. It's the time of day. So what are we going to do here? Press this button, I guess. Let's hope it all starts up. Yeah, I pressed that one, but nothing seems to display. Or maybe it'll come on soon. I tried that one, but it just turned it off. with this side?
Yeah, it's coming.
Oh, it's finally warmed up again. Okay. Okay. Be a bit patient. Okay. So just to get back to what I was saying is, my goal in you studying this course is for you to see how all these things work and to be able to use this information. It's not about you memorising stuff out of a textbook, learning a whole lot of stuff, but being able to say, this is a problem, this is how I can fix it, and I have an analytical framework. So what we're teaching you in this course is to develop analytical conceptual frameworks to understand the things that are going on. So just by way of getting you past that introductory stuff is to look at what we're going to talk about today. Now, I want to just run through all of these, and we'll spend some time, but there's a lot of notes here. And along the way, please ask questions. Anytime I make some statements that you don't understand, come and ask a question. But we want to understand some of the theories. What's behind regulation? Why do we have regulation? What are the explanatory variables? Understand some of the objectives, different types of frameworks, and different approaches, particularly what we call a rules-based versus a principles-based approach. They tend to be the models or the classifications we have for regulatory approaches. We're going to come back on another topic, talk more about corporate governance, and then we'll look at some of the different things that have gone on in countries, and then look at how the accounting profession as a group has responded to regulation. Now, in building up our model, you need to sort of think about regulation as being part, as I began today, about a big picture view. So what we want to understand are the different wings or arms of regulation. So when I talk about a Prime Minister or a President, it's very real. So keep in mind we've got a political side to regulation that is going to be responsive. Okay, we're going to have various interest groups and lobby groups all pressing for regulation. Now that could be environmental regulation, it could be control of the workplace safety rules. If we have industrial accidents, a lot of rules change there. So we've got a political process, we need to understand that. We're also going to have the so-called out of the political process, we have a legislative process. Then we're going to have various bureaucratic process, the government agencies, the regulatory bodies, the organisations that are set up to manage that. And we're also going to have various concerns from the various interest groups and groups that are involved at that level. Now, these are all interrelated. I'll put them in different areas because one is a political side, and the way that works, it works differently in different countries, obviously, but they all will have, I'm talking about a democratic type of country, not an authoritarian or centralist type of country. But political processes, we've normally got people who are interested in accounting regulation, generally fall under the Ministry of Finance, Treasury, someone like that. So normally a political process, we've got a Prime Minister, and we'll have various other groups. But in Australia, the person who's responsible for financial markets and financial regulation is our Treasurer, and all the regulation and regulatory mechanisms. Now, in the Treasury, the Federal Treasury, there's a whole lot of wings to that. It's a very big department. Obviously, it's the second most powerful part of any government after the Prime Minister's department or the President's department. So the Treasury, the finance people, they control all the money. So normally you've got your central bank, you're going to have all your securities agencies, securities market agencies, all your transactions, all your taxation, all these kind of things, all fall under that. So where does the government as a whole get its money? How does it allocate and spend its money? How does it control all the money? its country. So the Treasurer is very powerful. So in Australia, Wayne Swan's our Treasurer, and within that we have usually we've got the Parliamentary Secretary to the Treasurer, and then we'll have various other ministers and sub-ministers. So the Treasurer in Australia has 3 associated ministers and part of the cabinet process, and the Treasurer in this country is normally the Deputy Prime Minister as well. So it's a very senior position, second most powerful position in government. And the Treasurer is responsible in this country for all of our corporate law. The Corporations Act, you've been studying that with Sean. You're doing some corporate law with Sean Kearns? Anyone doing corp law? Or? Not yet, not yet?
No. But yeah, in bachelor.
You've done that? You already know your corp law. So you can tell me all about the Corporations Act. What's the body that administers the corporation? Yeah? You know the corp law?
No.
Not yet? Okay, so have a
It's
refresher.
more finances corporation.
Okay, okay.
It's
No,
not
it's
law
important.
that much.
Okay, so the relevant, we have quite a lot of agencies here that are going to be managing all these things. So all of what goes through government and through Parliament is legislation. So if there are problems in anything, the Prime Minister, Treasurer, or through the political process, lobby, but the Treasurer will normally introduce all of the bills into Parliament and speak to them if there's going to be amendments about their portfolio. So anything that affects the corporations law is introduced through the Treasurer's office, through the Treasury, and they will introduce all the legislation. So any legislation covering accounting, auditing, financial practices, corporate law and governance, all these sorts of things, all are going to be legislated. Okay, that's going to be interpreted through there. In terms of looking at this, we then have the legal system. So we've got a range through here, through the and when legislation is written, it then is interpreted. Most legislation is written in such a way that it is vague. That's the intention of legislation. Parliamentarians and politicians and the drafts people behind that generally prepare legislation in a loose, and this is sort of in the Westminster tradition, in a loose language. It's not always precise. And it's often not precise because people don't quite know what it's going to do, what its effects are going to be. So legislation will have an impact. There will be disputes. And how do we interpret that? We go to the court. The court will say, this is what's going on. So normally, when we're interpreting, the key law for us is the corporations law. Corporations Law of Australia, and that's got in it the establishment of the Accounting Standards Board, the establishment of the Auditing Standards Board, the standards on company operations and disclosure, and it's also going to have laws about various other agencies to advise the Minister and advise Parliament more generally. So this is sort of the structure that we've got, and that's sort of running down in this way. So we can go to a High Court, and then the High Court will make, if it gets to the full court, they will make an interpretation and say this is the law in a particular case. And this is how we interpret this, and then that becomes the precedent. And then people follow that through until such time as there is new legislation. So that's sort of just that interactive process there. Now, what we've got then is various bodies and organisations. And in Australia, ASIC, Australian Securities and Investment Commission, is the principal body currently charged with responsibility for overseeing all of the corporations law. Now, ASIC is chaired by Rod Metcalf, and it's a very big organisation, and it's an organisation that will often lead to prosecution. So ASIC will not only work through itself, but clearly works with other arms of government. It's a federal agency, and it will clearly often work, particularly if there are criminal matters, it works with the federal police. So the federal police will do criminal investigation on behalf of ASIC, and they work through the public prosecution to bring cases to the courts where there is seen to be a breach of the law. And then the courts will then interpret this. And so ASIC, it operates not only federally, but clearly through each of the states. Now, under ASIC, there's a whole lot of other instruments, and we mentioned some of those earlier. There's the Australian Accounting Standards Board, there's the Auditing Standards Board, and as a group that I've been involved with, I was a member of this group here for a long time called CARMAC, Corporations and Markets Advisory Committee. So CARMAC is a group I was, and these are, to get to these boards, to get to AACSB, these are ministerial appointments. So how do you get there? You go to the minister. The minister makes a recommendation for membership to Parliament, to Cabinet. Cabinet appoints the people, the members of these committees. So these people then are appointed through a Cabinet process to the boards, but they are, inverted commas, deemed to be independent. Same as that Commissioner of ASIC, independent of government, but appointed. So there's normally some bipartisanship. That means that in our kind of political system, if you're a Liberal or Conservative, Labor Party, there's notionally some consultation. But, you know, so these people are not seen to be representing party political views, but representing, I guess, professional advice. That's the theory of these sorts of administrative agencies of government. And then what we'll have then is the minister, through various, usually ministerial advisory groups or ministerial members, or through their federal agency. So in here, remember, keep in mind, we've still got part of this is Treasury. So we've got the main arm of Treasury, but ASIC is independent of Treasury, the same as the Commissioner of Taxation is independent, but they're all broadly part of that. So the person who puts their name on your banknote is the Treasury Secretary, these kind of people. Now, these are all working together. It's not like they're separate. So when I was a member of CARMAC from 2008 through 2011, we had on that board, independent board, chaired by an independent chairperson, but we used to have the Deputy Commissioner of ASIC, sits on CARMAC, the Head of Financial Markets for Treasury, sits in CARMAC, representatives from broad community interest groups, from professional bodies, from the legal profession, from government, all come and sit in these kind of committees. Likewise, in the Accounting Standards Board and Auditing Standards Board, we get this mix of views and policy views. And then, of course, any decisions that these groups make are fed back through to the Treasurer, because they're the people who have to stand up in front of the 6 o'clock news camera and say, this happened, what are you doing about it? Or what's your advice? So there's these groups tend to be behind the scene, making it all happen. Okay, that's part of our structure, our legal understanding, the institutional structure. So how do all these groups out here, we're going to have company directors, one of the key lobby groups. The Institute of Company Directors, the Group of 100. There's lots of different groups here. We've got the Company Directors Association of Australia, CDA. We've got lots of different lobby groups in the corporate director company space. These people, they have lots of different interests. First of all, they're probably going to come along to the Prime Minister and say, you want another $1 million for your next re-election? You do this. Maybe they don't quite say it like that, but that's the kind of message we understand goes on. I don't know what they do, but that's what we can assume. You want to get my vote? Here's some money for it. We know that's big. And of course, the parliament political process has a lot of controls. If you lobby and pay money to, particularly if you're a company and you're paying money to political parties, it's all got to be disclosed. Transparency, disclosure up front. But there's also a lot of informal. These guys might all, or women, get out and play a game of golf. Oh, Prime Minister wants a game of golf. Not our current Prime Minister, but some of them do. And walk around. Or maybe not the Prime Minister, their advisor. Come out for a game of golf. Do something like that. Have a bit of a talk. Okay? So that's how they can influence what's going on. So we can also have professional groups. Professional associations, the key ones that we're interested in, CPA and ICAA, your Certified Practicing Accountants, Institute for Chartered Accountants in Australia, two very important professional organisations representing about 250,000 people together. It's about 150,000 CPAs, about 80-odd thousand there. So quite a lot of people in the accounting profession. It's become a big industry. The financial markets are big industries today. Somewhere in the order of 20-25% of GDP is generated through financial transactions. And at the peak of the global financial before the crisis, 40% or more. And in some countries, 90%. A country like Iceland, more than 90% of all economic transactions in a country were financial transactions. So their whole GDP was based around finance at that time. But that's come back a bit now with the reweighting. But it's still a very important part, the whole financial services and financial transaction sides in most modern economies of wealth generation and income. So these are important professional groups. People like Alex Malley, our president of CPA Australia, spend a lot of time talking to these kind of people here, talking to these people, as well as talking to these company directors and things like that. So the auditors, the accountants are interested. Then we've got a whole lot of other interest groups, but the ones that I'll pick on today that shape us a lot through our media, particularly our electronic and e-media, blogs from a lot of influential people. You've got all sorts of information that comes through television and news, particularly financial news channels, Bloomberg's, these kind of media channels that influence what goes on, and then you've got a whole lot of specialist commentators that feed into that. So people from the big banks, people from the corporations, people from this group, all sort of feed through this media thing to shape public opinion. Why are they shaping public opinion? To influence this track down here, what's going on politically. And then you might have others, probably I'd say less influential. You've got universities. But at some level, these are very influential. So on a day-by-day basis, universities tend not to be the big players, because the big players are out here. But shaping the big ideas is these people. So the one person who perhaps is most associated with the global financial crisis is a person by the name of Milton Friedman. Okay, you know Milton Friedman, American economist. What's he famous for? You know basically what he said? Any rough ideas. This is back long before you were born, okay? He was shaping ideas, shaped basically the modern thinking. In the 1960s, Milton Friedman, Chicago School. You heard of the Chicago School of Thought? Yep. What's Chicago famous for? Freedom. Deregulation. Okay, deregulation. So, or freedom, you know, this notion of economic freedom, freedom of choice, growing the markets, belief in the market. So Friedman is an economist, and his philosophy was basically the markets will get it all right. The markets are smart. Okay? Why do you need any of this regulation? It's all a waste of time. It's a waste of government. Get rid of government, have small government, let the markets figure it out, and everything will be great. And that worked, okay. We had Margaret Thatcher, you had Ronald Reagan, the people who bought this Friedman idea. The 1970s and 80s, Thatcher and Reagan reshaped the world economy. They broke down regulation, broke down state ownership, and that's still to this day very true. So these notions of that came out of the Friedman philosophy led to deregulation, opening up of markets, and a refusal to regulate. So what happened during the 1990s, in particular, was another thing that grew out of the university sector was, and you probably heard this under various other guises, you know, the efficient market hypothesis, EMH. The markets will get the prices right. Markets are smart. There are lots of traders, lots of informed people, and they will figure out what's the right price for any asset, any security. Markets don't get it wrong. This is classic Chicago School, Farmer, Jensen, the famous economist that came out of universities, shaping the philosophy. This is a dominant global philosophy. It has not yet been replaced. Nobody is yet, although there's a lot of criticism saying markets aren't efficient, nobody's got an alternative model. So we still use efficient markets theory, and particularly your Black-Scholes option pricing model, you know, Black-Scholes option pricing, as the foundation for pricing all of our securities. Nobody's got an alternative to that yet. That's the Black-Scholes model is built on Jensen and Meckling's theories, which all come out of efficient markets. So this culture that evolved in the US universities in the 1960s and 70s, particularly in Rochester, Chicago, New York Stern School, Stanford, Harvard, the major economists and academics shaped the thinking of people, which led to a philosophy of low regulation and a belief that markets are going to get things right. So governments tended to back away, didn't get involved. Even if there were warning signs and crises, nobody actually did anything about it over here or elsewhere in the world because of these beliefs. So at this fundamental level, universities and professors and theoreticians do have a very big influence over this whole playing field, but not necessarily on a day-by-day basis. Probably not the big players in the short term. Now, why did these guys have a lot of influence? Well, they influenced the teaching and the curricula of all your accounting books and your finance books. And pretty well anyone who went on to work in one of the big investment banks took this along with them as their belief. They were all pretty smart people, usually very good quantitatively, high level of computational skills, and were able to use this technology to construct those instruments I talked about before, whether they're repos or various types of derivatives. They could play the games. They figured out ways to make those balance sheets look pretty good. And investors bought into them. Credit rating agencies certified them. So that explains what's going on. And so we got this belief then that the accounting program or the accounting practices were going to be reliable, they're going to be understood, we've got accounting standards, we've got a lot of knowledgeable people, everyone thought this is going to be right. Now, the consequence of all that is we've got lots of issues, and I'll just read you this. This is a quote from a book by Das, who's writing about the financial crisis. And he looks at, and I just want to, we'll read through all this and we'll have a look and think about it. Empty words like governance and oversight masked a lack of adult supervision of business and markets. A culture of benign neglect presided over increasing debt, greater leverage, higher risk, lower capital, and accounting fudges. So basically what he's saying is that these people here who are charged with watching the system basically thought, oh, these guys know what's going on, it's all okay, we've got good theories, got good analysis, and everybody was saying it's fine. So when all these tricks happened, it didn't benefit the markets because the markets were full. So financial statements were filled with page after page of lots of disclosures. You all looked at a balance sheet or financial statements? You looked at a set of those in some of your other courses? So, you know, they're 100 pages, 200 pages thick. Very big. But look, it's all about meetings and committees. Who was there? What was happening? It was about form over substance, a case of ticking boxes. So nobody looked at the underlying detail. It was like you're in a ship. You heard of the Titanic? You know this famous ship? Titanic. What happened? It sank, right. Okay, so we're on the Titanic. You're the captain. You're told, oh, everybody's got a seat, everyone's got a bed, everyone's got, 10 deck chairs, got a swimming pool, all tick, 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 tick. The ship looked good. It's all in apple-pie order. The motor's going, but nobody tells you where the ship's actually going. It's going to hit the iceberg. So nobody's looking at that strategy direction. Okay, this is the big issue. The ship is all good. You look at your financial statements, all good. But it's going to crash. Now, many accounting and many organisations are just like this. So what we've seen happen in financial analysis, and particularly in corporate reporting, is a really big transformation. And it hasn't quite caught on in Australia yet, but it's about, and this is going to be our key thing coming forward, it's about governance, or what we would call more fully corporate governance, but I just put the word governance up there. And governance is made up of one key concept that I believe is the key thing for any governance, and that's about where you're heading. You govern an organisation to make sure it safely gets to its destination, whatever its goals or objectives are. So governance links through to strategy. Corporate strategy is about your direction, you're heading this way, and we're going to come back and look at this separately. And then strategy is about getting all your bits right, so maybe all your deck chairs and your motors and your ship crew and all that. And then you can worry about your performance, okay? And that's a whole other area, and that's sort of another area that I spent a lot of time working on, talking to businesses and companies about getting their strategy right. So getting all your organisational structure right, meeting all your compliance obligations, all that kind of stuff. But critically, getting your strategy right. Most important. Through that, you'll get good performance. You've got your virtuous feedback loop then, back to good governance, and around you go. Okay, so key stuff. So we want to make sure in all of our accounting that we have a big picture view. We don't ever just look at the narrow one. You have to look at your environment. That's why this environment might include icebergs, could include shallow reefs, all these other hazards if we keep a nautical thing going. Okay. Now another issue that happens is, and this is something we'll come back to have a look at in a minute, is this whole area of how accountants get played. Because accountants are just players in this game here. Okay, they're this group here, this accounting. And keep in mind there's lots of other professional associations there. There'll be all sorts of different vested interest groups, but we're just interested in accountants. So this is from Sir David Tweedy. Now he's the chairman of the IASB, very important and very powerful man. And what he said is auditors were picked off by bankers. They would come up with a scheme, whether it's one of these pearls today or whatever that Commonwealth Bank are doing, and they will try and get them through. So they create an instrument that appears to be legal. Maybe it's got to get tested in court, or maybe people believe it's legal. And they'll get an opinion from a QC. A QC stands for a Queen's Counsel. And this is like in English language, because this speech that this is taken from was actually delivered in Ireland. So it's from a high-profile lawyer. A QC is a high-profile lawyer. So you get an opinion from a lawyer that what you're doing is okay. And then you tell the next person, oh, look, I've got this. This must be okay. So you put pressure on other people. So the third party, not to criticise or qualify. And then once they get that through the line, they say, oh, this must be true and fair. This is the outcome. Now what he's talking about there in that quote is one of the breakdowns here. And this is again what happened in Lehman Brothers and these kind of cases. That they would create collateralised debt obligations. And they would structure them. And then they would go and get them assessed by credit rating agencies. And they would say, everything's good. Your financial statements are good, or your instruments are good. They are valid financial instruments. And then no one would question them. And then you get this act of faith. And then you get this kind of situation 5 and 10 years later where people take them to court because these things actually become proven to not have the economic substance that they originally promised to have. So this is a kind of consequence of this. We call this opinion shopping. Opinion shopping. Now I know you do guys play this in uni, don't you? You ever tried opinion shopping? You can. What happens if you get a fail in your assignment?
What happened if I fail?
You get a fail in an assignment. You do anything about it, you say, oh, I failed, that's too bad. Yes. You try and get a remark, don't you? Okay, a lot of students do anyway. Maybe you. But a lot of students, oh, I didn't pass this one. Oh, can I have a remark? Can someone tell me? So the same thing happens in financial markets. You're a good student, you don't ever get remarked. Oh, you don't need to, you pass everything, okay? That's good. Okay. But we call it opinion shopping. And the same can happen in medicine, in law, everywhere. Accounting. Everyone's looking for opinion. Why do we go? We've got professional bodies. People are not going to have the same view on everything. So you go to the accountant. You say, oh, I'm going to do this. Will you sign that off as agreed? And the accountant say, no, that's no good. You go to the next guy down the road. Will you sign? Oh, yeah, that's okay. Oh, yeah, that's good. Okay, I got the right opinion. You do that all the time. Not you personally, but people do that. They shop for opinion. You go to the doctor. Oh, I feel crook. Oh, go home and lie down. Oh, no, I want some drugs or something. Okay. You go to the next one. Oh, yeah, here's some drugs. You can have them now. So you shop around. We know people do that in medicine. They search around for a doctor to give them the opinion they want. So not the one they need, but the one they want. And the same happens in accounting. So this is what this is an example of. And we know that happened a lot in the pre-financial, and still happens today. People are looking for opinions to help them get what they want. If you're a businessman, you make some deals up, say, is this legal? Oh, not quite sure. Okay, well, take to the next. Yeah, that's legal. We'll sign that off. So once you've got that backing, it can get tested in court. Goes up and down through here. The legal system doesn't always get it right. Okay, we know that happens. We know people go to jail for murder. Oh, 10 years later, oh, DNA, you didn't do that crime. You can come away now for free. Same thing happens in financial affairs. People get charged on a particular event, and it could be that maybe the evidence wasn't right. They go through appeal, or maybe the law, as interpreted by the court, is not what was looked at. Okay? Now, that then gets fed back through. Okay, we have a law that's not good. It'll come back through a discussion process, bureaucratic process, and then we may get new legislation. And often a legislative intervention is to fix up issues that have come about as a result of the interpretations that the courts have given of particular current legislation. They get new one to replace that. Now, these kind of things happen from time to time, and a famous case recently in the financial area is called Sons of Gwalia. Sons of Gwalia is a gold mining company, and Sons of Gwalia case, we had an interesting situation where the company had, or the board of directors of the company and through the company had produced a financial report and a prospectus that was found to be misleading. Now what happened was that some of the shareholders who'd come into the company after the prospectus has been issued, so they invested in the company, went to the court and said, we have been misled. We've been misled. Now, what that meant was the court heard this. I went to the High Court of Australia. When the court heard about this, it said, and eventually Sons of Gwalia was placed in liquidation. These are shareholders of a company, and these shareholders were treated as though they were creditors. They had a claim against the residual assets of the liquidation. So it was a way of challenging that old accounting equation where the court actually moved some of these equity holders into the creditor class, unsecured creditors, and said these people have a residual claim, a prioritised claim against the assets. Now that's very controversial because the fundamental philosophy of Western capitalism is that there is a distinction between debt and equity. An equity holder has residual claim, no prior claim, just a residual claim on assets, net assets. That's the philosophy. You are a risk taker. You buy equity, shareholders, you take all the risk, but you also get all the gains. That's what it's all about. You can make all the money, you can lose all your money. That's the philosophy. So what the High Court did is said, hang on, you guys took a risk. You bought into a company and your risk didn't pay off, but we're going to compensate you. We're going to now treat you as though you're a debt holder for the purpose of liquidation. Now that to me is fundamental breach of Western philosophy. From the time of John Stuart Mill, people like this in the 1800s wrote about principles of Adam Smith, all these kind of famous economic philosophers. So we had in 2006, 2007, the Sons of Gwalia case, and the High Court actually, in my view, and in the view of many other people, made a major mistake. It fundamentally refused to understand the principles of Western economic philosophy. Now, why did that happen? And it happened because, remember earlier we talked about Margaret Thatcher, Ronald Reagan? What did they do? They said, we're going to make everybody shareholders. They had a philosophy of opening up the stock market to everybody. They said, it's better to have, they talked about the broadening of capitalism. So everybody got to become shareholders, broadening the interest group. So we had privatisations, British Telecom, British Transport, same in the US. Happened in many, many countries around the world through the 1970s, 80s and 90s and even to today. A lot of government enterprises are continually being privatised. And what that means, and what it did mean particularly in the early days, was that there was a lot of people became shareholders who had never been shareholders before. And we've got in our Western culture two conflicting issues. One is what we call consumer protection law. And consumer protection law is designed to protect consumers. So if you go to buy a car and the engine doesn't work or the brakes don't work, after it's a new car, not after an old one, or even if it's in a warranty period, you have protection. You can go back and get it fixed up. Okay, we have this. We say a person who sells goods and services must sell them reliably, competently, and things like that. And if there's not, you have rights as consumers. So we build this culture of consumer protection. What happened during the 1990s and early 2000s is through a lot of issues, consumer protection and investor protection got confused. Two fundamentally different views. Investors, traditionally, unless they're debt holders, but investors in equity, are risk takers. They're not consumers. But what the governments did and what the High Court did is got confused. They thought that investors were like consumers. They were buying securities. They're just consuming securities. But these securities are residual risk takers. And so through the High Court, we got the confusion of consumer protection law and investor protection law. We've got the Sons of Gwalia case actually saying that equity holders are in fact like consumers. They need to be protected. And then there's going to be compensation. They become debt holders. Now all of that eventually through this case was turned on its head, and we then had intervention through Carmack, through Treasurer and others to get the High Court back on track, to say that even if you are misled in a prospectus, that it is not a breach of the law, that you're still a shareholder, you're still a risk taker. Now why is that the case? And I think there are a few things that explain that. When you're a risk taker, you take lots of risk. One of the risks you do take is what I call managerial risk. That is that you are buying the trust of the managers in the company. If they happen to be bad guys and steal your money or don't tell you the truth, that's a risk you face. It's just the same as technology risk. If you buy a product that is going to be superseded because some new technology comes along, your product is no longer valuable. You face commercial risk. You have a product that has commercial value, a new marketing campaign for an alternative product comes along and dominates that, this product gets wiped out. So we see the same thing happen all over the place. Commercial risk, managerial risk, there's environmental risk, there's all sorts of risks. So when investors invest in a company, the people you're investing in really are these company directors. Are these true fit and proper people to govern the company? Do they provide that good governance? Do they tell the truth? Can you rely on them? And have you got auditors and other people? You take a risk. Yeah, I think that's pretty true. I'll put my money in this company. That's the way it should be. Anyway, the point of all that is this is an example of interactions and things that occur. So this little diagram here is one that gives you a bit of an overview of the kinds of things, how it all fits together. And I talked about Milton Friedman and Jensen and Meckling and efficient markets and all these. This is like our philosophy. What's going on? What's our philosophy? Is it regulatory? Is it interventionist? Is it low regulation, high regulation? How do we approach the philosophy of the market? That sort of oversees it. Then we've got a various structural, what we call an architecture. Who are the bodies? What kind of, do we have a regulatory agency, a securities commission, some other agencies involved? How does it all fit together? What kind of approaches do we have to regulation? How do we go about regulating? And then we've got various oversight. Now keep in mind, I'm trying to focus as much as I can on the accounting side, but it's a sub-part of a much bigger thing. So in Australia, we would look at what, and this is called the macroprudential, the oversight of the whole market. Now one of the criticisms of the global financial crisis is that nobody had the big picture. Nobody was actually looking for the iceberg. Everybody was too busy looking at their part of the ship. So one of the things that we expect to come out of this is better macroprudential supervision. The overall risk-taking. What does the central bank do? What does APRA, the Australian Prudential Regulatory Authority, do? How does that tie in with ASIC and the Securities Commission? How does that tie in with the Stock Exchange? That's another group that I haven't put here, so very important, which is something we need to talk about later. ASX, Australian Stock Exchange, and the various other self-regulatory agencies. So all of these things fit together, and then in this pool here is a whole lot of subsets that we'll look at. So the market intermediaries, the banks, the brokers, the various agents, the commissions, how's that all handled? Financial providers of financial services and products and things like that. Then you've got the actual products. What are the securities that we have in the market? So are they equity, shares, derivatives, loans, CDOs, all sorts of different types of traded products. They can be in cash form, in futures form, calls and puts. There's millions of different varieties of those. There's currency swaps, there's hedges, there's, you name it. People are inventing, and every day they're probably inventing new ones. Then you've got what we call conduct rules. These are rules such as transparency and disclosure and fraud. So we're looking at what goes on in the market, all the different conduct. So we're looking for integrity, honesty, ethics, corporate and individual ethics. And then you've got the institutional oversight and what we call the self-regulatory authorities or organisations like the stock exchanges and things like that that run independently. So these are some of the things that we'll come back and have a look at. Now you need a break, I think. You've been very patient. You normally have half an hour or 10, 15-minute break?
Yeah,
15 will do you? Okay, so come back about 22. You got any questions? Not so far?
waiting for the rest.
Waiting, oh. I'll be tired by then. Okay, so you've got to have some questions, okay? At the end of the day. So we'll go on, we'll paint some more pictures. See, Pablo Picasso was pretty ordinary. He didn't paint a picture like that, did he? Big mess. Jackson Pollock, you know him?
Yeah.
Okay,
Yeah.
that's the financial market. It's a big mess. Someone's going to try and fix them up, but I don't like their chances. Okay, off and have a break. Yung, do you have to turn this one off too? Okay, I hope it's recording okay.
Yeah, I think so.
Okay. The idea is to touch your toes, stretch back, do lots of exercise. Okay, all fit.